Okay, we're back with Corbin Cordila from Tip TV Education. Hi, Corbin, how are you doing?
Hi, Zach, how are you?
Right, basically we were looking at sort of the basics of, I suppose, pricing, currencies, getting a handle on their flows, and now we're going to look at how this demonstrates itself in the real world.
Precisely. So once you've identified that there are underlying factors that drive currencies, the question is, how do you extract value? How do you construct a portfolio that makes money over the long term? Let's be mindful of the fact we're not saying that every portfolio is going to make money all the time. That's maybe an illusion that people tend to have of a system. But in aggregate, combined together, they do contribute to a long-term growth strategy. And again, you can see that in equities. I mean, nobody expects the high-tech sector in equities to make money year in, year out. I mean, we saw it blow up in 2000. Nobody expects utilities to make money year in, year out, and they had their strength at some point in time, similar for value stocks versus growth stocks. But in aggregate, the S&P has performed. So for all those people who love to buy and hold or trade around just the S&P, bear in mind, similar structures exist within FX. So we'll start out with the carry portfolio. This represents the P&L by trading interest rate differentials in currencies. And there are two components to this P&L. One is your usual spot price move. So for instance, let's say you're buying Aussie yen because Aussie has a high interest rate, yen has a very low interest rate. So therefore Aussie yen you'd expect to move up. But by holding that position, you're also implicitly earning the interest rate differential. And you can see that, for instance, if you have MT4, you can see that in your swap column. Every day you have money flowing into the account purely from this interest rate differential. Now, this portfolio is actually a very simple construction, and all it says is every month you look at the high interest rate or the currency with the highest interest rate, the currency with the lowest interest rate, and you trade that currency pair in favor of the high yielder. Most recently, over the last year or so, it's been Kiwi Swiss, and for obvious reasons. Kiwi Swiss itself has traded in a range up and down, which explains the oscillations we see towards the end of this chart. Over the long term, this only goes back to 96, but you can construct this index even further down. If you have the data, you'll see over the long run, it provides and produces money.
But this looks very easy. Looks easier than equities. And obviously easier than trying to trade short-term movements in dollar-yen or euro-dollar, et cetera, This is like the slow game, and it seems to be much more logical. And you're buying Aussie, it's got a higher rate, set against the yen, which has got a lower rate. Sit back, relax.
Precisely. So the question therefore is, how can you use it to your advantage if you have a much shorter time horizon in view, for instance, a week, maybe a couple of days? The very fact that you understand that long-term flow, so interest rates tend to affect currencies over a time frame of 3 to 6 months. So if you understand what the flows are, and these flows are driven by central banks, by real money as they call them, asset managers, corporations, etc., you can pre-position yourself. So we said towards the latter end of this chart, the preferred position was Kiwi Swiss. Now, what you can do is bring up a chart of Kiwi Swiss and look at exactly what are the opportune moments from a shorter term time horizon to trade this currency. This currency has been range bound with very strong support resistance levels. So in that particular case, wait for the opportunity to present itself to buy and enter that currency pair. Would you want to sell it? Well, bear in mind, selling that currency pair will incur a loss on a daily basis of half a pip, because of this interest rate differential, which is actually quite significant. If you choose to hold this currency for, let's say, 3 months, that is actually 90 days, so 90 days times, so that's 40, 50 pips you're already losing. On the other hand, if you were to hold Kiwi Swiss, you'd make these 50 pips out of thin air, and by timing your strategy appropriately, you can then participate in the spot move as well. So this is the carry strategy. The next strategy is based upon what we discussed previously, in terms of value. Value meaning if I have two identical goods from different countries, I should be able to swap them out. That implies an exchange rate that is based upon tangible goods and represents the value of the currency. So if I look at the currency exchange rate in the market and it's massively too expensive, I sell it. Again, you have a universe of currencies. My preferred universe tends to be the G10 currencies, so it means the dollar and the usual suspects, including NOK and Stocky, the Scandinavians. And then you look at who's the most oversold, overbought, and again, you form a currency pair. And this has been tremendously well performing over the last 22 years, as you can see on this chart. So this, and as we'll see later, also exemplifies the idea that just because one component, one portfolio hasn't performed recently, doesn't mean that the entire idea doesn't work, because another component will have produced. For instance, as a classic example, 98, 99, tech stocks went through the ceiling. Buffett's portfolio went down 50%. The S&P didn't. The reason for that, of course, is that Buffett famously said that, had he been there at the demonstration of the Wright brothers, he would have taken a bazooka and shot them down. He didn't believe in new technology or investing in stuff he didn't understand. So he was purely in value stocks. Value stocks tanked throughout that period. But growth stocks made money. In aggregate, the equity markets made money. And so this is the same idea of having different factors combined together to generate steady long-term growth. The next portfolio is based upon momentum. Now, this is actually quite relevant because other than just making money consistently, it does tend to have spikes, and that's the whole point about momentum. It tends to be very spiky. But you see around the 2008, 2009 area a spike to the upside, and that was dominated by the yen collapse or the yen cross collapse. At that point, a lot of funds who were playing the carry trade didn't have a momentum strategy to overlay it and got very much hurt by the fact that dollar yen, Aussie, and all these yen crosses just fell through the bottom. Having that component of your portfolio would have helped you greatly in removing that loss out of trading the carry trade. And of course, momentum, as you say technically, is orthogonal, means it's completely separate as an indicator from carry. So what we're really doing here is we're looking at separate pieces of information. We're looking at interest rates, at value, and at carry. And the fact that they're separate means you're adding information to your view of the universe, which is extremely important. If you just trade one thing on one asset, you're all over the place. So what happens when you combine all these factors together? You get something that's much smoother and much more tradable. That is the whole point. It's like, yes, I can solely trade Amazon or solely trade Apple or solely trade God knows what, Johnson & Johnson, but these will go through their cycles of ups and downs. The whole purpose of aggregating them into a portfolio is to have steady growth, as we see in the S&P. Similarly, the purpose of putting these FX factors together is that you create a benchmark that continuously creates value. Now here's the key thing. How do I have confidence it will continue? And this is really the job of a trader. Yeah. It's not just formulating an idea, it's about how do I have the confidence that this idea will continue to generate value? Well, the only way to do that is to have it underpinned by fundamental factors. We know that interest rates and cash and people looking to have high interest rates will always be there. I mean, show me somebody who's not looking for a high interest rate. Things do have value and it reverts to value. And there's always crowd behavior for momentum. These things will continue to be like that. Unless, of course, the markets change, society changes, but I guarantee you, if markets go to hell and people don't follow these ideas of optimizing their growth rate and their wealth, then you can forget about our
So actually, perhaps if things get too rough, the principles will actually be stronger rather than weaker here.
Well, no, what I'm saying, the principles could vanish if we have a complete societal change, like we all turn communist, which hopefully won't happen.
Well, it didn't happen in Cuba, did it? Sort of.
So the purpose of this slide is actually to highlight something very important. We created a benchmark out of the various factors, and now we can ask what is its performance and how do we compare it to the other indices that we know out there. So the Sharpe ratio is of the order of 1. That means that on average we expect to make money 2 out of 3 years on this kind of strategy. We expect it to be fairly smooth in returns and the drawdowns not to be too big. And this is certainly shown by the fact that your maximum drawdown you experience was 7% compared to an annual return of 5%. To be very clear, the leverage I use to create these benchmarks is 1. Obviously, within the FX world, your benchmark, your leverage can be much, much higher. Yeah. Brokers out there, of course, offer something like 1 to 500. You don't have to trade that. But even if you were to trade 1 to 5, these returns would be much higher. How does this compare to the S&P? Well, we know that the S&P has a Sharpe ratio over a similar time span since 93, 96 of 0.5, 0.6. So actually, this benchmark performs much better than the S&P. But now this is fantastic. The S&P is about equities. This benchmark is about FX. And as I keep on saying, if you have completely unrelated pieces of information, stick them together, you perform even better. So not only should this be a strategy in and of itself of allowing you every month to see how I should trade around the currencies, if I were to combine with an equity strategy, I would even know, should I do equities this month? Should I do FX this month? What's my outlook?
So you're almost stealing from other markets to improve your performance in this area.
Precisely. And the next slide is really the call to action. So if you like this series of educational videos, You'll find much more information and much more depth, especially in terms of how to construct this long-term approach on my website. So do please sign up to my newsletter.
And just you were talking about the long-term approach. What is a typical? Is a piece of a string question? But what would be a typical time frame or the minimum time frame required to properly benefit from the way you operate or your strategy?
That's a very interesting question. So a lot of people talk about cut my losses, preserve capital, and the gains somehow grind themselves out. But we're all humans with a need to satisfy particular ambitions and goals. One thing that always gets overlooked is that the most fascinating question when you trade is, how long does it take to double my money? And of course, everybody will say, you want to make 100%, stop being so foolish, nobody does it, blah, 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 blah. Well, that's actually not true. The reason the hedge funds don't do this is because they'd have to leverage themselves up to the eyeballs, and the minute they do that, the pension funds call up and fire them. As a private individual, that's not the case. So let's going back to Sharpe ratio. So Sharpe ratios tells you how much you'll make for every dollar you bet. So on average, if I bet $1 with a Sharpe ratio of 1, I'll make $1. And as we saw, creating something that has a Sharpe ratio of 1 is not that difficult. If you add other assets, other indices, it's not that difficult either. So let's say that you rebalance your portfolio every 2 months, every 2 weeks, or every month. Then on average, with a Sharpe ratio of 1, you should be able to double your money in the order of 10 months. That's actually quite interesting. If you use the right leverage, you can stand to double your money on a yearly basis. Which is a phenomenal answer, I personally think, because it goes against the grain of what everybody says, oh, be conservative, be conservative. No, it takes courage to be a pig. Understanding the right way to be a pig means that you can really leverage up. And ultimately, trading is about making money. It's about having fun doing it, and it's about doing it in a very rigorous way. So that's really what the framework I'm advocating. You can make a lot of money, but you can do that intelligently without the stress.
Right, and finally, if somebody says, this Corbin guy is just, is still too clever for me, how much hands-on sort of backing and support do you give so that people can understand how to do this? Because most people are like literally throwing darts at the screen. Or it's just like it's probably embarrassing how simple and each click of the trade is. If people say, well, I really want to do this, but it's a bit daunting. What's the way forward that you offer?
Ultimately, markets are about numbers. So if you can manipulate a spreadsheet, or you can look at a spreadsheet and type a number into a spreadsheet, then you're done. That's really the technical prerequisite. As I said, all the information you require to formulate an opinion is freely available on the internet. So for instance, for the value portfolio, I urge you, go to the OECD website, dig around to find the current exchange rates, list them out for the main currencies, and you can do this on a piece of paper as well and see, this is the most overvalued, this is the most undervalued, oh bam, I know my currency cross now for the next month. Similarly for interest rates, if you go to something called global-rates.com, it lists out the interest rates for the main currencies. Not so much for Aussie, Kiwi, CAD, because they stopped quoting LIBOR. So you'd have to go to the central bank's website, but they'll have the 3-month interest rates there. And again, list out your interest rates on a piece of paper, and bam, you've got the cross you have to trade. And similarly for momentum. So maybe conceptually, word-wise, it's unfamiliar jargon, but as you make it very clear, which I do, it's actually easy to construct them. The information is freely available. It doesn't require any calculations, and it's there to be had for anybody.
Corbin Cordilla, Tip TV Education, thank you very much for talking with me today.
Thank you.
We'll be back after the break.